Okay, guys, welcome to today. We're going to cover income tax today. We will work through a FAC 3 question paper, test 1 2018. So that's going to be the focus of today. I'm going to give you a quick, like literally very quick recap on income taxes, and then we're going to go straight into the question. And then through the question, we will work through the question. We will cover and we will cover some more items, and we will also iron out any questions you may have. So let's understand the whole purpose of income tax. So what's important to note, so income tax is dealt with in the accounting standard IAS 12. The IAS 12 deals with income taxes, which is made up of two things, current tax and deferred tax. Sometimes many of us just think it's dealing with deferred tax, but it's dealing with current tax and deferred tax. Now, the whole purpose of deferred tax, so current tax is the tax that we calculate based on what the tax authorities wants us to calculate. So here in South Africa, we based on the what SARS would expect based on the Income Tax Act. So that is what current tax is all about. What do we have to pay the tax authorities? Then we have a concept known as deferred tax. Deferred tax is an accounting concept. It's got nothing to do with the tax authorities. So that's very important to understand. So when you work through a question, when you are working out current tax, always remember that current tax is what you need to calculate from the perspective of the tax authorities, what we're going to pay over to the tax authorities. Deferred tax is an accounting concept. The whole purpose of deferred tax is to ensure that the income tax line item in the statement of profit or loss and other comprehensive income represents an accounting number. Think about it like this. When we go through the income statement, we go sales, cost of sales, gross profit, other income, other expenses, profit before tax, income tax, profit after tax. Now everything, sales, gross profit, sales, cost of sales, other income, other expenses, and that gives you profit before tax. All of those line items are calculated or determined in accordance with accounting rules and standards, okay, accounting rules and principles. Now we come to the income tax line item. Ignore deferred tax for now. Now we come to the income tax line item, which includes current tax, and that is based on what the income tax says. Okay, the Income Tax Act says, or your country's tax authority says. So that is that line item. And then you get to a profit after tax. Now that profit after tax now represents an amount that is partly accounting, partly SARS. And accountants are saying we actually want that income tax line item to represent, we want the profit for the year to represent a purely accounting number, which means that income tax line item needs to change to represent an accounting income tax line item, or an income tax, what you would expect from an accounting perspective. And that is where deferred tax comes in. Deferred tax tries to ensure that the income tax line item is based on what accountants expect. So that is our purpose. Unfortunately, deferred tax can't account for everything, and the reason for that is because there are certain instances where there's always going to be a difference between how SARS treats something and how accounting treats something. And because of that, we will never be able to align. But in cases where the way SARS treats something and the way accounting treats something is the same, we will have deferred tax consequences. So just take note of that. Our purpose for income tax to a large extent, especially for test 1, is the reporting of income tax. So why is that? Remember, the whole purpose of financial reporting is to provide users with financial information that is useful for decision making. That's the conceptual framework. The way we do that is by preparing and providing financial statements. Financial statements is all about presentation and disclosure. So when we come to income tax, what they're going to test you is presentation and disclosure. They won't test presentation as much because presentation is one line item called income tax, which you will see in the income statement. But what they're going to test you quite thoroughly is that on or that of the disclosure of income taxes. And that is what we're going to deal with. You need to read your standard and go to disclosures. There are plenty and plenty and plenty of disclosures that affect income taxes. We're not going to go through all of that. We'll do the typical ones, but you need to read through the standard and then see what you need to disclose. The standard also provides you with a model answer. When I say model answer, basically how the disclosures should look, and you can have a look at that to get an idea. But we will cover the most common ones. So make sure you are able to disclose your financial, you're able to disclose income taxes in the notes to the financial statements. The ones that are most common is basically the income tax note and then the tax rate recon. So the income tax note and the tax rate recon. The second one that is important is from the balance sheet perspective. So there's two. So for the balance sheet perspective, it would be the deferred tax recon. Okay, so you must be able to do those three things. So just make sure that's all the typical ones, because while those are typical ones, if you pick up a set of financial statements now, pick up any set of financial statements now, you will see an income tax note, you will see a tax rate recon, and you will see, if I can say, a recon of the deferred tax balance. When I say a recon, it's not exactly a reconciliation, but basically you need to explain what numbers make up the tax rate, makes up the deferred tax balance. So for example, deferred tax is made up of the temporary difference in PPE, the temporary difference in intangibles, whatever you did to calculate your deferred tax balance, whatever assets and whatever liabilities you included in your deferred tax table, that will need to be disclosed, just the line items with the final amount. So just make sure you're able to do those type of things. If that question comes in, simply grab it from your, simply take it from your deferred tax calculation. Okay, so that is basically the main disclosures. I hope you read your standards. They will tell you in for the tax rate recon. The tax rate recon can be disclosed in two ways as a company choice, but in two ways. One, using numerical numbers, and number two, using a percentage. So they're not going to tell you, they're going to use the standard paragraph. They're going to say, prepare the tax rate recon in terms of paragraph, in terms of IAS 12, paragraph 81C1 or 81C2. Now 81C1 tells you either numerical, and then the other one says percentage, whichever way it goes. So you're going to need to know that. Either you memorize it, or you're going to have it, your books with you, and you know where to look for it. So just make sure you do some type of reading over you do some type of reading over your accounting standards. Just one last thing, deferred tax is a very important section where they can test you on, or they can test you on discussion, okay? Where you must explain the deferred tax calculation to the CEO, and because you're writing to the CEO, you can't use accounting jargon. You will put accounting jargon in there, but you'll have to explain it in a manner that the CEO, as a non-accountant, would understand. So make sure when you go through the deferred tax calculation, you can explain it in words. It is one thing to say it out in words, it's another thing to write it down. So spend some time to write it down. If you do your deferred tax table like this, so I had a few students that do a deferred tax table like this. Assets positive if tax base is greater than If carrying amount greater than tax base, it is a deferred tax liability. If if it's an asset and carrying amount is less than tax base, it is a deferred tax asset. If that's going to be your explanation to the CEO, you're going to get straight zero. Okay, your explanation still needs to be technically correct, technically sound, um, and then but in layman's terms. So you can't tell the CEO we have a deferred tax liability because PPE, which is an accounting the carrying amount of vehicles from an accounting perspective exceeds the tax base of vehicles, and therefore that does not explain anything. That is just telling you how you got to the number. So keep in mind you must be able to explain. So a deferred tax explanation would look something like this. A deferred tax explanation would go something like this. My carrying amount is based on the accounting treatment for vehicles, which is covered in IAS 16. The carrying amount, as we have, is 100,000 rand. The tax base for vehicles is all is what SARS will allow as a deduction in future periods. The current tax base is 80,000 rand. So I'm explaining to them what you call it. For a carrying amount of accounting, you must say that is the future economic benefits that you expect, which is 100, and your tax base is the future tax allowances. That's your tax base, 80,000 rand. And then you will say that results in a temporary difference of 20,000 rand. From an accounting perspective, this 20,000 rand this 20,000 rand temporary difference is considered to be a taxable temporary difference. A taxable temporary difference means that in future we will be paying more tax. You have to tell them why. And then from an accounting perspective, a taxable temporary difference results in a deferred tax liability. That is how you explain. I only explain from a one-line item, but there'll be many line items, but that is how you must go through it. So explain what does the carrying amount represent as an accounting number, and what does that accounting number represent. Then there's a tax base. The tax base is a SARS number. What does that SARS number represent? Then that gives you the temporary difference. Then you must tell them what this temporary difference is. Is it a taxable temporary difference, or is it a deductible temporary difference? A temporary difference is taxable if in future you will have to pay more tax. The temporary difference is deductible if the temporary difference is a deductible temporary difference if in future you will pay less tax. Then you will tell them, what does this mean? What does a taxable temporary difference mean? Taxable temporary difference, you explain it, so that results in a deferred tax liability. Deductible temporary difference, you explain what that means, and you will say this results in a deferred tax asset. You must be able to explain it like that, okay? From a statement of financial position perspective. You can explain it from an income statement perspective, but stay away from that side. You can be able to think through it, but stay away because your explanation needs to be from a statement of financial position perspective, because that's how the calculation is also done. Take note that, what did I wanted to say now? Slipped my mind. Oh, deferred tax. What's important to note? Deferred tax. What is deferred tax? It is future tax consequences from an accounting perspective. So deferred tax represents future tax consequences. So if you have a deferred tax liability, it means the future tax consequences mean in future you're gonna have an outflow of economic benefits, which is basically you have to pay your SARS more. A deferred tax asset, it means it's a future economic benefit that you're going to receive. So that means in future, your tax will be less in future. Okay, remember, SARS don't give you money back. So it just means a deferred tax asset means in future, you'll be able to reduce whatever taxable income you have. So make sure you understand the technicalities, but being able to explain it to the CEO, who is a non-accountant. Because you may be dealing with someone in you may be dealing with someone who is an engineer. You may be working an accountant for an art company, and then you're dealing with a humanities person. Absolutely no clue what's happening in accounting. Okay, so just remember that. You may be dealing with a lawyer who does not know numbers. So they must be able to explain all of those type of things. So remember, it's important to understand who you're writing to, who is the audience. Okay, so that's it I wanted to cover. Now I'm going to go straight into the question. The question is on page 90 or 91. No, actually not 90. The question is on, so it's test one 2018, page 110. Okay, so you can go to page 110, and then we're going to go through it. I'll read through it, the short scenario, because they set it out nicely. I'll read it with you, and then we'll go through it. But while we get this, do you have any questions? Ashita, Fakir, Lerato, Mahlati, Rebecca, Ryan, any questions?
No questions.
Okay, so we're all good. So we're going to go to the scenario now. I will share my screen. Do you see my screen? Do you see the question? Question 3. We're going to deal with whatever that is. Lalana.
Yeah.
Okay. Okay, so go read as follows. Ignore any VAT implications. You are an IFRS expert who is employed by this consultants, J Consultants. The following independent and unrelated issues were brought to your attention for your expert advice and opinion. So we're going to do client 1 only, because that's the income tax calculation. Have a look at that. This question is worth 18 marks. Your test 1 is 40 marks, so it's almost 50%. Okay, so take note of that. If you go through the various questions, you will realize that quite a bit of marks comes from income tax. Although take note, in 2020, test 1 last year, there was no income tax question. Okay, so don't now go study income tax to a point where you know it inside out. Then in the test comes no income tax. So make sure you spread it nicely, because test 1 2020 did not have income tax. So let's read. Client 1, Lalana. Lalana is a company operating in the manufacturing and maintenance industry. Lalana is listed on the Johannesburg Stock Exchange and has a 31 December financial year end. You are currently reviewing the financial statements of Lalana. Your assistant has presented the following schedule of information relating to the year ended 31 December 2017. So take note, you're busy with 31 December 2017. That means your financial year is 1 January 2017 to 31 December 2017. So item, and then they have the item and then the rand value. So they say Lalana's accounting profit for the year ended 31 December 2017 after it correctly accounted for all items is 5,750,000 Rand. Now, what's important to take note, whether you highlight it, whether you remember it, is that that line item is correct. Okay, there's no adjustments you need to make. A typical income tax question could be they give you the income, the profit before tax line item. So they give you the profit before tax line item. So firstly, it's a little bit unclear what that line item is. They said profit for the year. Okay, so I guess we can assume it's profit before tax, but they should have actually said which profit line item it is, okay? But we can assume it's profit before tax. But what's important is that it is correctly accounted for all items. In a typical income tax question, they would give you a profit before tax line item before taking into account some items. Okay, then you have to read through the items and see which items have been correctly accounted for and which items have not been correctly accounted for. So please take note of that. You must distinguish between the profit figure that is 100% correct. So that means there's no adjustments you need to make. And the profit figure that you will most likely still have to make one or two adjustments. Okay, so please take note. Okay, so let's go through the next line item. Dividends received. They say dividends received are exempt from normal tax in terms of section 10(1)(k). Now you are in test one. You get the question paper first, then you get the required. Okay. What you should know is when you enter that exam, so the benefit of test one is that you only went through a number of questions, okay, topics. So you already know that when you go into test one fact, you must already know that all they can test you on is conceptual framework, presentation of financial statements, inventory, income tax, changes in accounting policies, estimates, and correction of errors, and fair value. Okay, so that is the six for fact for CTA 2 students with fair value, for CTA 1 students, no fair value. Okay, so fair value is only in CTA 2. So basically, six topics. So you must already sit back Monday evening when you are finished study at 6 o'clock. I hope you're not going to study till 12 o'clock. Okay? You need some good rest. But anyway, whenever you're done studying, you must be able to sit back, have a cup of tea or have some water. Now, I always say that, but I was one of those that couldn't. But anyway, so have some tea or have some water, not alcohol, of course, and go through each in your mind, go through each topic and take note of and have a mental check of all the major stuff within that topic. So when you read the scenario, when you come and you see it's fact one, you must already know it's one of those six topics that will be that. So any of those six topics will appear. So when you read this over here, you probably would know that this is going to be an income tax question. So why is that important? Because you know the income tax question, most likely, don't just go hands in because you don't know the required. You must know that they're telling you dividends received is exempt from income. So what did accounting do? Accounting said debit bank, credit revenue, okay, or credit other income, wherever they want to put dividends. So let's assume they put dividends in other income. So accounting would say debit, bank, credit, other income. So what did that do to profit? It increased profit. Okay. As a result of an increased profit, accounting expects an increase in tax. However, from a SARS perspective, dividends received is exempt. So therefore, what does SARS do? From an income statement perspective, SARS do absolutely nothing. SARS does absolutely nothing. SARS says there's no income. Okay, why? Because it is exempt. So please take note of that. Okay, so therefore, there is a difference between accounting and SARS. The question you need to ask yourself, is this difference temporary or is it permanent? If it is a temporary difference, you need to see this in your deferred tax calculation. If it's a permanent difference, you need to see this coming through in the tax rate recon. So what I would make note over here, somewhere where it's easy for me to pick up. So either on the far left or on the far right, okay, of the page. So either in front of dividends received or after the RAN column, you will tell yourself it is a permanent difference and you will tell yourself tax rate recon. Okay, so identify that it's a permanent difference. Now we go on over here. The other say foreign income received after deduction of 5,000 Rand relating to foreign taxes is 35,000 Rand. They say the foreign income tax is not taxable in South Africa. So generally, why a foreign tax won't be taxed in South Africa? Because remember, you need to think about this from a tax perspective. From a tax perspective, as an individual, whether you're a company or not, if you are a resident, a South African resident, you are taxed on your worldwide income. So why, in this case, is this foreign income not taxed? So this is a resident company. How come are they not taxed on the foreign income? Because from the gross income definition, all residents will be taxed on their worldwide income. So that means foreign is part of the world. So how come they're not taxed? So generally in the real world, in order to avoid double taxation on the same now. So I'm a company or I'm an individual. I'm in South Africa, but I'm earning money from overseas. America is going to tax me. Now SARS also wants to tax me. So I'm going to have the same money. I'm earning one money the same and it's being taxed from two jurisdictions, South Africa and America. So what countries have? They have a double tax agreement in place. So generally this happens with a double tax agreement where the foreign country will tax you because that's where the money was earned, and the local, whatever you call that, they won't tax you to avoid any double taxation. Okay, so that is why over here, the 35,000 Rand, we got taxed 5,000 Rand, but South Africa is not taxing you, most likely due to a double tax agreement. Okay. So here's an important aspect to take note whenever you see foreign income. From an accounting perspective, and this concept is going to come through in impairment as well. So from an accounting perspective, every income and every expense must be recognized before tax. So every income and every expense must be recognized before tax. Why? Because the tax line item is accounted for separately in the line item called income taxes. So in this type of question, what generally happens is the accountant do the following. In the bank account comes 35,000 Rand. So all the accountant does, he says debit bank 35, credit other income 35. The problem with that is that 35,000 Rand is after tax because you earned 40,000 Rand in America or in a foreign country. However, they only pay 35 because they withhold 5,000 Rand. So from an accounting perspective, the correct treatment is as follows. Debit bank 35,000 Rand, that's what you physically receive. You must credit other income 40,000 Rand, because you must credit it at a before tax amount, and then you will say debit income tax 5,000 Rand. So generally, if line item 1 didn't say everything was accounted for correctly, you'd have to make an adjustment to your profit figure, because your profit figure is your profit before tax amount is including 35,000 Rand, but it should include 40,000 Rand. But in this question, they are saying everything is correct. So you can assume that they have correctly accounted for the income as 40 and not as 35. So please make a note here, somewhere make a note, because in another question, you're going to have to make a 5,000 Rand adjustment. Please, it's an easy mark to not lose. Okay. Do you have any questions on that line item? Okay. Now we go to the next line item. So this year is there will be a permanent difference, because you need to work out how much South Africa would have taxed you. If South Africa had to tax you, the before tax line item is 40,000 Rand. The income is actually 40,000 Rand. So if you say 40,000 Rand times 28%, you will get a number. You must compare that tax number to the 5,000 Rand. So that difference between the two is considered a permanent difference. Why? South Africa is never taxing you, so they're never going to tax you at 40 times 28%, yet you have been taxed at whatever percentage, it gives you 5,000 Rand. Hence, the difference between what you actually have been taxed and what you should have been taxed is a permanent difference. So please take note of that. We will iron it out when we actually tackle the question. Then we have gain on land, on disposal of land. Lalana purchased land for the future development of a new factory on 31 March 2016. 31 March 2016 is in the prior financial year. Due to the recent availability of factory buildings in the area, Lalana sold the land at an amount of 1,550,000 Rand on 1 January 2017. 1 January 2017 is the current financial year. The original cost of the land amounted to 1.2 million. Land is measured according to the cost model in terms of IAS 16. The proceeds from the sale of the land is a receipt of a capital nature for tax purposes. So, we got rid of land. To get rid of an asset, you get rid of an asset at carrying value. So we say credit asset credit land at carrying value. So for land, carrying value and cost price is the same thing. So we're going to say credit land 1.2 million, debit bank 1.55 million, and hence there's a difference of 350,000 Rand. So we're going to say credit gain on disposal 350,000 Rand. So included in profit or loss is a gain on disposal of 350,000 Rand. From an accounting perspective, accounting want that to be taxed. One tax will take place on the full 350. But you know, from a SARS perspective, any capital amount is taxed at 80%. So please note, there will be a permanent difference between accounting and SARS of 20%. Why? Accounting is always going to expect to tax 100%, whereas SARS will always only tax 80%. So that 20% difference is a permanent difference. So take right there, permanent difference, and that will have to go to the tax rate recon. Same thing with the 35,000 Rand. The difference between what the tax should have been and what the tax is results in a permanent difference. So you're right there next to permanent difference, and it will also go to the tax rate recon. Just one important point to make note of here with this gain on land. If this amount had to go through OCI, so the only way this can go through OCI if there was a partial, if you use the revaluation model and you revalued the land from 1.2 to 1.4 million. So any revaluation on land, any revaluation on PPE goes through OCI. You must take note from a tax rate recon point of view, and from an income tax point of view, we're only focusing on profit or loss items. Because remember that income tax line item is the line item that comes after profit before tax. And that gives you profit for the year. So any adjustments you are making, any tax calculations and tax rate recons and so forth is only from a profit or loss point of view. So you must separate profit or loss from OCI. Take note, this number could have easily been ignored because it is OCI. But in this case, it's not an OCI line item, so therefore we're taking it into account. Now we have depreciation on PPE. The tax allowance on the plant and equipment amounted to 900,000 Rand. On 31 December 2017, the carrying amount of plant and equipment amounted to 3.1, while the tax base is 2.5. So remember the carrying amount of 3.1, that is what accounting is saying. That is what we expect as future economic benefits. This is what SARS say. 2.5 million is the future tax allowances. So the current year's tax allowance is 900,000. The current year's depreciation is 876. There's a difference between 876 and 900. That is a there's a difference, but in this case, it is a temporary difference. All temporary difference we factor in to our deferred tax calculation. So you want to expect this you want to expect this column or this row to come through in the deferred tax calculation. Here we have correction of error. Okay, so they bring in correction of error because you covered correction of errors. So one of the topics. So that's how they factor correction of error in. They're bringing it through this deferred tax calculate or this income tax question. So they say on 30th November 2016. 30th November 2016 is the prior financial year. Lalana received an amount of 300,000 Rand from a customer for services that were rendered during the February 2017 financial year. So you received money in 2016 for services you were going to provide in 2017 financial year. The accountant recognized the 300,000 Rand as revenue in 2016. For tax purposes, the 300,000 Rand was taxed in the financial year ended 31 December 2016. So let's understand what took place. The accountant did the following. He received 300,000 Rand in 2016. So he said, debit bank 300,000 Rand, credit revenue 300,000 Rand. However, what should he have done in 2016? He should have said debit bank 300,000 Rand, credit contract liability 300,000 Rand, or income received in advance 300,000 Rand. The correct term is contract liability. I'm just using income received in advance for ease of explanation. So why is this? So remember, that is what he should have done. You can't recognize revenue in 2016. Why? Because the service is only rendered in 2017. But we'll explain this further when we deal with that issue. But all you need to know that from an accounting perspective, we should only be taxed in 2017. However, SARS is taxing you in 2016. Why? SARS taxes, if you use the gross income definition according to the Income Tax Act, the gross income definition includes that SARS taxes you for income taxes for gross income on the earlier of accrual or receipt. So we received the amount before we recognize the revenue. So therefore, SARS is going to tax us. It's the earlier of receipt and accrual. Receipt was the earlier. And then here we have an assessed loss. So they say, Lalana suffered operating losses during the previous financial year and had an assessed tax loss of 900,000 Rand on 31 December 2016. So this assessed loss took place, was already there at the financial year end 2016, which was last year's financial year. So we need to see how we're going to deal with that. So there's an impact last year, and that's going to have an impact this year as well. So they say the company correctly utilized 344 of the assessed tax loss by recognizing a deferred tax asset of 96,000 relating to the assessed loss on 31 December. Should be 2016, but okay. So let's go further. There are no temporary differences other than those above. The only non-taxable and non-deductible items included in the accounting profit are those above. The normal tax rate is 28%. The inclusion rate is 80%. You may assume that all amounts are material. Okay, the junior like to say that because students likes to be smart using the conceptual framework. They will say we don't need to adjust for this because it's immaterial. Like in the real world, you look for everything to be immaterial, so you don't have to do it. But remember, in the academic world, everything is material. So let's get into this. Before we go on, is there any questions you have on the line items? Any questions? Fakir, Rebecca, Mahlatsi, Lorato, Ashita,
Uh,
Ryan, Valise.
no questions.
Okay, so they say prepare the income tax note to the financial statements of Lalana for the year ended 31 December as required by IAS 1279, IAS 1280, and IAS 1281 C1 income taxes. Refer to Client 1. Comparative figures are not required. The movement in temporary difference in the current tax calculation has to be calculated by using the statement of financial position method. Okay. So 81C1, that refers to how the tax rate recon needs to look. So this C1 is numerical. I think 79 and 80. One of it is just basically the income tax note in terms of how you separate the income tax note, and then 80 is whatever. Okay. I'll pull up in so I'll pull up the I4S just now, then I'll show you. So let's go to the actual question. So they say, dear student, prepare the income tax note. That's what they said. Okay. So when you have to prepare, you need to follow the 3 rules. Company name. So this is Lalana Limited. I think it was Limited. Then you're going to give the statement name, which is notes to the annual financial statements. Notes to the annual financial statements for the period. This period is a year, so we say for the year ended. Then you can put the date. I just put my date below to show the 3 different aspects. They don't care about where you put the date. Well, they like the date next to year ended. I just put it here for our purposes. 31 December 2017. Okay, so that's what we need to do. What do they ask us to do? They ask us to prepare the income tax note. So you're going to tell them here's income tax. So when someone sees that, they know they're looking at income tax. So now we're going to do the income tax. So what needs to take place in the statement of profit or loss and other comprehensive income, you have a line item called income tax. All we are doing, we need to explain how the income tax line item is made up of. Okay, so just take note of that. So here the heading is generally say major components of income tax, whatever they call it. Okay, so you can look at the proper wording, but I know it's major components of something. So this is how you think about it. The major components of income tax is broken up into 2 parts. SA normal tax, and then foreign tax. Okay. So please take note that we have major components, which is made up of SA normal tax and income tax. That's the 2 parts. Local tax, foreign tax. The local tax is called SA normal tax. Okay. Now, SA normal tax has 2 parts. Okay. We will have current tax and we will have deferred tax. So just take note of that. So the thinking is as follows. I just do here. So you have your statement name, you have your the note name income tax, then you will say, now you must say which note are you dealing with. We're dealing with the major components of income tax. You can just look at the proper wording, but it's something major components of something. So that is the note, that's the disclosure we are dealing with, major components. So our major components of income tax, think of it like this. It's broken up into 2, SA normal tax and foreign tax or local tax and foreign tax. What we call local tax is a normal tax. Okay, so that's the two. Then take note that SA normal tax is broken up into two parts. It is broken up into current tax and deferred tax. Now, under current tax, you must list the different types of current tax. Under deferred tax, you list the different types of deferred tax. And then under foreign tax, you list the different types of foreign tax. So for our purposes, it was just basically foreign income. Okay. So ours was foreign income. Over here, under current tax, there will generally be, they can generally be two things. It will be current year tax, current year tax, and then under or over provision, under over provision, yeah, under over, no, that's what I'm not, and you're missing on something. Prior year okay. So this is the thinking. You need to know which disclosures you need. So for us, it's the major components and the tax rate recon. Under the major components, you think of it like this. It is local and foreign. So our local we call SA normal tax and then our foreign tax. Okay, so that's the two parts. Under SA normal tax, there's another two parts. Current tax and deferred tax. Then you must list the different current taxes and you must list the different deferred taxes. So for SA normal tax, or I mean for current tax, there'll generally be two things, the current year tax and the prior year under over provision. In this question, there's no prior year under over provision, so you don't include that line item. I'm just including it for completeness purposes. Then under deferred tax, this is, I think, paragraph, so IS 12, paragraph 80, I think that one deals with the tax, deals with deferred tax asset disclosures. So deferred tax will always have the one, okay? So it is called movement in temporary differences. So we'll always have this one because we always have temporary differences. We always have a deferred tax balance. Then below this, you need to mention the different types of assessed losses. So assessed losses can be like three things. In this question, we have two. So I'll mention the two when we get there. I don't want to bring it in now because I want to show you how it comes in. So let's go through it one last time. In order to answer this question, they asked you to prepare the income tax note and they told you which paragraphs to apply. So you go to IAS 12 and you find those paragraphs. Let's just see if we find those paragraphs quickly. So I'm going to go to Psycha. So Psycha have like the COVID educational things. So you, even if you're not a member yet and you can't sign in, it's on their website. Okay, so now I'm on the I4S side now. Okay, so here's all the things over here. I'm going to go to disclosures. I'm going to go to disclosure. And you can look now for, so there, paragraph 79, the major components of tax expense shall be disclosed separately. Okay, and they say the components of tax or income may include. They don't say shall. May means these are the typical items, not limited to that. So can you see? Can you see the? Can you see the? Can you see the IFRS? Hello.
Green screen anymore. It was on the screen now, but on.
Okay. So you must read, eh? Make sure you read the standards. So here, major components, happy. They say paragraph 79, paragraph 80. Paragraph 80 explains further what the components may include. So current tax, we have that. Any adjustments recognized in the period for current tax of prior periods. That's what I had a line item. Prior year under over provision. There's nothing in this year. I just included it for our purposes. Then the amount of deferred tax relating to the origination and reversals of temporary differences. That is a line item under deferred tax that we have called movements in temporary differences. A more technically correct would say origination and reversal of temporary differences. But uh, I think what you call is okay with calling it movement in temporary differences. Generally, that's what the solution have. But that would be the correct term, origination and reversal. Then the amount of deferred tax relating to changes in tax rate. So that's going to come into play next year when the tax rate changes. Okay, so if there's a change in tax rate, we'd have a line item over here. We'd have a line item over here called change in tax rate. Okay, so just be aware of that. So that's going to come into play next year. If they want to, if they feel like it, they can bring it in now, but I doubt it. Then the amount of benefit arising from a previously unrecognized tax loss. Okay, and the temporary difference of a prior period that is used to reduce current tax expense. We will bring this in this question. The amount of any benefit previously unrecognized of prior, okay, whatever, you can see whatever the difference is, but we're going to bring this in. And then the deferred tax expense arising from the write-down or reversal of a previous write-down. So for example, if we had an impairment loss and then we have a reversal of an impairment loss, you'll have to show that separately. And then the amount of tax expense relating to those changes in accounting policies. Okay, if there's a change in accounting policy, we will have to bring that in separately. We have to show it separately. Okay, nothing in this question. So G and H not in this question. Okay, and same what you call is not in this question. B is not in this question. D is not in that question. In this question. Then they say 81C1. Okay, so here's 81. The following shall also be disclosed separately. Okay, you must be. This is number 8, where you must split it out separately. But anyway, we want to go to 81C, an explanation of the relationship between tax expense and accounting profit in either or both of the following. 1 or 2, it is a numerical reconciliation between tax expense and the product of accounting profit multiplied by the applicable tax rate, disclosing also the basis on which the applicable tax rate are computed, or a numerical reconciliation between the average effective tax rate and the applicable tax rate. Okay, so what's important, this one is just saying a numbers, and this one is just saying percentage. Okay, so just be aware of that. that is a disclosure that we need to do. So we have to do two disclosures: major components of income tax and the tax rate reconciliation. Okay, so we're okay with that. So here we will still have some more things. We will have some deferred tax. Deferred tax asset related items. I'm not going to put it in now. The ones in red is not required in this question. The ones in red not required in this question. Okay, I'm just putting it in for completeness purposes. So once again, the way you think of it, you prepare your statement and you do income tax note. Which income tax note are you doing? The major components. For the major components, we split between local and foreign. The local we call SA normal tax. Under local, under SA normal tax, we have two further splits, which is current tax and deferred tax. Under current tax, we show the current year's tax, and we show a prior year under over provision. Under deferred tax, we show the movement in temporary difference. This is the correct term we call origination or reversal, but movement is fine. It can be a change in tax rate, and then it will be anything relating to a deferred tax asset. So we will have the deferred tax asset in this question, okay? And then that, once we add up everything, that will equal to our, this will equal to our income tax. So this income tax amount needs to equal to the income tax on your statement of profit or loss and other comprehensive income. Okay, so this should equal to our statement of profit or loss and to our statement of profit or loss. Okay. Then the next is the tax rate recon. So tax rate recon. So this one over here covers the disclosure of paragraph 79 and paragraph 80. Now we are doing paragraph 81C, okay? But more specifically, we're doing paragraph 81C1. And we're going to do the tax rate recon. So the way you're going to do that, start off with profit before tax. More actually, what you should actually say, you must say accounting profit before tax. You must state the word accounting profit before tax. And remember, in this question, there were no adjustments required. Our accounting before tax is at 5750. Okay, just remember. Then you need to get the tax on that. Tax at 28%. So if you read carefully paragraph 81C1, they tell us what is the accounting profit. Okay, so tell us what is the accounting profit before tax, and then tell us what is the tax on this. So the way it says, take the normal tax rate of 28%, whatever the normal tax rate is, for our case is 28%, and multiply it by the accounting profit before tax. So this is the tax that accountants are expecting. Based on their profit before tax, that is the tax the accountants is expecting. We need to explain what is the difference between this number highlighted in yellow and the other number highlighted in yellow. The tax rate recon explains what causes the difference between that 1.6 million and this income tax that we actually have. Okay, so just take note of that. So we'll answer this question now. What goes into the tax rate recon is only permanent differences. Okay, so what goes into the tax rate recon are permanent differences. More specifically, what goes into the tax rate recon is what accounting did and SARS did not do, or what SARS did and accounting did not do, that relates to permanent differences. Then we're going to list all our permanent differences to get a particular answer. Then we're going to list Like then we're going to list all our permanent differences. Remember, based on what you already picked up, we know there's a permanent difference of dividends received. That's one of the permanent differences. There was another permanent difference, which was the foreign income. And then there was another permanent difference, which was the CGT on capital gains. Okay, so when we went through the question, as we read, we noted down what was a permanent difference and what was a temporary difference. So dividends received, we say there's a permanent difference. Foreign income, we say there's a permanent difference. The gain on disposal, we say there was a permanent difference. The depreciation, we say there's a temporary difference. The correction of error, we say there's a temporary difference. Okay, and then there's also no, it's not that. Okay, so just take note of that. So please make note that are our differences. Just as a red line item, I just want to add in a red line item. What will also be a permanent difference is the following. If you had to have it, what will also be a permanent difference are the following. A prior period under over provision and a change in tax rate. So if we had this would also be this will also come through in the tax rate recon. Okay. So please take note. Okay. Now we can go and actually answer this question. I'm just going to do the working separate because I'm going to scroll forever. So I'm going to do the workings over here. So while I'm writing out this, I'm going to ask a random person to tell me how would you go about calculating current tax? So we're going to work out current tax first. So tell me, how would you go about calculating current tax? Does anyone want to take a chance and tell me how to go about calculating current tax? Any takers? So we're going to calculate current tax. Any takers? Fakir, Rebecca, Mahlati. Anyone want to take a try? Yes or no? You can say no if you don't want to.
We start with doing the deferred tax calculation.
Okay, so you will solve the deferred tax calculation. That's fine. Then after that, what did you do?
Then I do the current tax calculation using the accounting profit and then adjust for any exempt differences and then temporary differences coming down to current tax.
Okay, so that's what we're going to do. We're going to start, so to calculate current tax, we're going to start with accounting profit and then adjust for differences between accounting profit and taxable income. Okay, so take note. We're going to start off with accounting profit and adjust for differences between accounting and SARS to get to taxable income. There are two types of differences. We have permanent differences and we have temporary differences. Okay, so To work out current tax, we'll start off with accounting profit. What is our accounting profit in this question? It's one of the three questions.
5,750,000.
5,750,123. But I just want to issue a note of caution over here. In this question, we could simply take our accounting profit of 5.7 million because they told us that everything was accounted for correctly. In another question, they could have given us this 5.7 million or this 5.7 million, but there may have been some adjustments we would need to make due to some errors. Okay, so generally the first calculation would be calculating the adjusted profit or calculating the correct profit. So you start off with the profit figure they gave you, make all the adjustments to correct the profit figure, and then get to a new profit figure. I usually just call it the adjusted profit figure. And then you use the adjusted profit figure over here. Okay, but in this case, we take it as is because there are no adjustments that need to make. Are we clear on that? Are we happy on that?
Yes.
Now we can adjust for the two types of differences. What are the two types of differences? Permanent differences, and temporary differences. Okay, remember, they told us that the temporary difference needs to be performed using the statement of financial position method. So that's where we do the deferred tax calculation. So all I'm going to do is I'm going to put in here movement in temporary difference. So movement in temporary difference. So all I'm going to do over here, I'm going to call it movement in temporary difference. So there's just one line item. And this will give me taxable income. But remember, I'm not looking for taxable income, I'm looking for tax. So to get to tax, it will be tax at 28%. Okay, so that's ultimately what I'm looking for. So it will simply be taxable income multiplied by 28%. Okay, but I'm not going to do it now, I'll do it at the end. So that's what we're going to do. You start off with accounting profit, adjust for differences to get to taxable income. Once you get to taxable income, multiply by 28% to get to the tax number. Because remember, current tax is based is calculated as follows: taxable income multiplied by 28%. Taxable income is profit from SARS's point of view. So that number needs to represent how SARS would tax you. Okay, so just keep that in mind. But the way we go about doing this is by starting off with accounting profit. Makes sense? Because when you become a financial accountant, you're probably going to have to submit the income tax return for your company. And on e-filing, the way you do a tax the way you submit on e-filing is by starting off with accounting profit and then adjusting for different stuff. One of the reasons would be because SARS knows that your income statement, you have all your information. So if you start with profit before tax and they want to reconcile, they just need to use your financial statements and whatever schedules you provide them to be able to find the necessary numbers. So it makes sense that you don't start like we do in the tax. Like in tax, we do go from scratch to work out a taxable income number. But in the real world, we start off with accounting profit and then get to taxable income. So just take note of that. Now the differences is twofold: temporary and permanent. We don't list the various temporary differences because we have already listed it in the deferred tax calculation. So we just go fetch it from the deferred tax calculation. But we must list the permanent differences because we're not showing it anywhere else. So our permanent differences we have identified to be dividends received, We have identified to be foreign income. We have identified it to be what now? So the other one, capital disposal on land. Okay, so let's work through this. Included in accounting profit is 75,000 Rand dividends received. Because it's the income in account, that dividends received increased accounting profit. From SARS's point of view, they don't want it over there. So therefore, we need to remove it. The way we remove it is by subtracting. So we need to reduce accounting profit. So I'm going to say again, not 750. So I'm going to say again, included in the 5.7 million of accounting profit is dividends received of 75,000 Rand. From a SARS point of view, that is exempt. They do not want to tax it. So in order to correctly account it from a SARS point of view, we need to remove it. The way we remove it is by subtracting it. Why? Because dividends received increased accounting profit. So to remove it, we need to decrease.
74,500.
Oh, 74,500. 74,500. Included in accounting profit is foreign income of 40,000 Rand. Remember, they showed it there as 35. But like I told you, from an accounting perspective, we always record an amount before tax. Why? Because tax is showed separately. In the very first line item, I told you the accounting profit was correctly calculated. So that means they treated that 35,000 Rand correctly. So what did they include in other income? Is 40,000 and not 35. Because 35 represents the after tax, where 40 represents the before tax. So therefore, included in accounting profit is 40,000 Rand other income. That increased accounting profit. SARS is never going to, SARS is not taxing this ever. So therefore, from a SARS perspective, we need to not have it in taxable income. So to remove it, we also have to subtract. Then the disposal on land. Okay, included in other income or included in accounting profit is a disposal of land of 350,000 Rand. From a SARS perspective, they're only going to include 80,000 Rand. So accounting have 100, SARS only 180. So how are we going to get from 100 to 80? We need to reduce by 20%. Okay, so all I'm going to do, I'm going to say equal 350, 123 times 20%. Okay, however, I need to reduce it. I need to go from 100 to 80. The amount currently increased our accounting profit by 100%. It should have only increased accounting profit by 80%. So what do I have to do? I need to take out, I need to remove 20%. The way I remove is by subtracting. Are we happy with that? Any questions? Are we okay with that? Okay, I'm assuming we're okay. Now we can work out the movement in temporary difference. Okay, so now we can work out the movement in temporary difference. So now we're going to work out deferred tax. We will start off with the 2016 balance, and then we will get to the 2017 balance. They never gave us the 2016 balance, so therefore we need to calculate it ourselves. So the way we're going to do it is going to say 31 December 2016, and we're going to list the various assets. So here's going to be details, Here I'm going to have carrying amount, tax base, temporary difference. I just, what I just do, I just say 100%. I just have this line item as well, or 80%. You don't have to have this line, up to you. And then I have tax, oh, no, sorry, then I have deferred tax at 28%. Okay. Now we need to list the various assets and liabilities that were present in 2016. So going back to the scenario, they never gave us specific balances, so you can only look through the notes. Okay, so in the first one, it is only accounting profit, so there's no asset, no liability mentioned over here, so there's nothing over there. Here they have dividends received. Here's no indication of any asset or liability, so we can ignore. Here's foreign income. So here's no indication of any asset or liability, so therefore we don't have to say do anything. Then we have disposal of land. They do mention an asset, and they do mention an asset is no liabilities, but there is an asset. So the asset over here, sorry, the asset over there is land. So the asset over here is land. So here we have land. They told us the carrying amount is 1.2 million. But remember, land, they're using the cost model, so it'll only be the cost price. There's no revaluation and there's no depreciation. But they're not using the revaluation model, so there can't be any revaluation. From a land perspective, there's never depreciation. The tax base for land is always going to be the cost price, which is also 1.2 million. So therefore, temporary difference is, the temporary difference is carrying amount minus tax base. Okay. This is going to be a percentage. Okay, so yeah, this is going to be 0 because there's no temporary difference. So therefore, I'm just going to leave this blank. I'm going to leave this one blank because there's nothing. So all I'm going to say is equal to temporary difference multiplied blank. There's no need to put 100 or 80 because there's nothing. And then multiplied by 28%. Okay, so that is that one. Then let's move on to the next one. But I was going to do 2017 one time so that we don't need to read the same information again. So that date we also have, I'm also going to include land. But remember, they sold the land at 1 January 2017. So at 31 December 2017, there is no land. So the carrying amount is 0. The tax base must also be 0, but there's nothing. So therefore, by applying the same formula over here, we have nothing. Okay, so that is fine. That's covering for both 2017 and for both 2016 and 2017, this line item. So they purchased land on 31 December 2016, 31 March 2016. At 31 December 2016, they still had the land at cost price. Then we go to the 2017 financial year. They sold it on 1 January 2017. So at 31 December 2017, there's no more land. So there must be 0. Okay. Next line, depreciation. Over here, they mention they are mentioning a tax base and a temporary difference over here. What are they saying? So the tax allowances on the plant and equipment amounted to 900,000 in the current year and 876, 31 December. Okay, and so our carrying amounts, 31 December 2017 is, what was that now? Plant and equipment. So we have plant and equipment. The carrying amount, the carrying amount at 31 December 2017 is 3168 million. The tax base is 2.5 million. Okay. So the temporary difference is carrying amount minus tax base of 668. For plant and equipment, it's going to be based on 100%. Because only a capital asset is based on 80%. So everything will be 100% other than a capital asset. So therefore, my deferred tax on this line item would be as follows, 187,040. Okay, now that's dealing with 2017. So the question is, what is 2016? They never gave us 2016's amount specifically, okay? They never gave us 2016 amount as they gave us 2017, but we are able to calculate 2016's amount. 2016 amount is simply going to be the 2017 balance plus the depreciation, 876, 123, because the only way that the carrying amount went from 2016 to 2017 was through depreciation. So therefore, by adding depreciation back to the 2017 number will give us what we had as at 31 December 2016. Applying the same rule for, applying the same thinking for tax base, it will be the 2.5 million plus the tax allowance that went through the current year of 900,000 Rand. Okay, so therefore that would be the tax base over there. I'm going to use the same. What's the temporary difference? It is going to be the difference between carrying amount and tax base. Plant and equipment is based on 100% because only a capital asset would be based on 80%. And so basically the temporary difference at 100% multiplied by the tax rate of 28% gives me a temporary difference of 180. Just to explain this over here, remember that would be a deferred tax liability. Why is it a deferred tax liability? It is because that line item only is a deferred tax liability. Why? Because we have a taxable temporary difference. Why is that a taxable temporary difference? Because in future, we'll be paying more tax. So how do we know this? So I just want to show you the thinking behind it. How do we know that we're going to be paying more tax? So let's have a look at this. This is an asset, okay? That 4 million Rand represents future economic benefits. So accounting saying in future, we're going to receive 4 million Rand. What it also means is in future, we are going to depreciate 4 million Rand. Because remember that balance is going to be depreciated over the remaining useful life. So over the remaining useful life, what's going to go through the income statement over the remaining useful life is a depreciation expense of 4 million Rand. So we expect our tax to be reduced by 4 million. We expect our taxable income to be reduced by 4 million Rand. However, what is the tax base? The tax base is 3.4 million. The tax base represents future tax allowances. So from an accounting perspective, we expect our tax to go down by 4 million in future. However, what is it actually going to be reduced by? From SARS's perspective, they're only going to allow us to reduce by 3.4. So if we start off with a simple number, let's assume the only difference between accounting and SARS is plant and equipment. So let's assume before this plant and equipment adjustment, profit before tax is 1 million rand. So for accounting, it's 1 million rand. For SARS, it is 1 million rand. I'm just going to make this 4 million rand simple. I'm going to call it 4 million. I'm not going to say 4,044,000. Just to keep it simple, I'm going to call it 4 million. So sorry, so that means our income tax, let's say our profit before tax is 10 million. So accounting profit, 10 million, SARS, 10 million. The only difference is a plant and equipment. So let's assume in future, our profit before tax is 10 million rand. Now accounting say, okay, in future, we want to deduct 4 million rand as depreciation. So they say 10 million minus 4 million gives me 6 million rand. So in future, our profits is going to be 6 million rand, and we want to pay tax at 28% on 6 million rand, whatever that number is, okay? Now when SARS do the calculation, SARS also start with 10 million rand, but now SARS reduces the 10 million rand by the 3.4 million rand. So what do their profit before tax, or their profit before tax, which is their taxable income, comes to? 10 million minus 3.4 gives you, what is that? 6.6 million. So accounting want to pay tax on 6 million, where SARS is saying you're going to have to pay tax on 6.6 million. So therefore, from an accounting perspective, we're actually going to be paying more tax than what we expect. That results, because we're going to pay more tax in the future than what we expect, that is a tax. So that means this plant and equipment is a taxable temporary difference, and as a result we have a deferred tax liability. So when you have to discuss it, that's the way you're going to discuss it in an exam, exactly step by step in that manner, explaining the accounting logic behind it. Okay, I just saw I had a question over here. Oh, it's a late thing. Okay. Is there any question at this point in time before we move on? It's important for you to make sure you can explain this line item. So this line item is a taxable temporary difference, which means it is a deferred tax liability, a deferred tax liability. Okay. So for every line item, you must be able to pick up. We don't look at every line item. We look at it at the total. However, you want to be able to, for every line item, be able to explain whether it's a taxable temporary difference or a deductible temporary difference. Remember, a taxable temporary difference results in a deferred tax liability. A deductible temporary difference results in a deferred tax asset. And the way you think about it is all about the future tax consequences. What do accounting expect the future tax consequences to be, and what the actual future tax consequences to be? If what they expect is less than the actual, then it is a liability. If what they expect is more than actual, then it is an asset. So just remember that. Let's move on to the next line item. So here we have a correction of prior period. So what should have happened last year? They should have said debit, bank, credit, income received in advance, or credit, contract liability. So last year there should have been a liability. Because it's a correction of an error, we go back in time. So when we do the current deferred tax, we must correct the current deferred tax. So the correct current deferred tax that we're doing now in 2017 relating to 2016 would include an income received in advance or a contract liability. Okay, so this is a liability. So from an accounting point of view, we have a liability of 300,000. From SARS's point of view, they have nothing. Okay, so this, if I do that, we have a temporary difference of 300,000 Rand, and this is not a taxable, this is not a capital gains amount, so we're going to include it at 100%. And therefore we're going to have that 84,000 Rand deductible temporary difference. So now in 20, I'm going to bring this one in as well, contract liability. In 2017, there's no contract liability because we provided the service, so there'll be nothing. You don't have to have all the blanks in. I just put in the ones that have 0 just to show completeness for our purposes. In an exam, you don't have to do it. It'll probably just waste your time. Okay, then we have this assessed loss, but we'll do the assessed loss afterwards. So we do the assessed loss separately. So we first work out this line item. So I'm going to add it up. The reason why I work the assessed loss separately, it is because accounting wants you to disclose assessed loss separately. So let's quickly do this over here. Okay, they said we correctly dealt with the assessed loss. So last year we had an assessed loss. We had an assessed loss of 900,000 Rand. So last year we had an assessed loss of 900,000 Rand. Okay, so from an accounting perspective, there's no carrying amount for an assessed loss. But from a SARS perspective, there is an assessed loss of 900,000. Okay, so what do we expect our temporary difference to be? We expect our temporary difference to be 900,000, but they told us that we correctly treated it by only including 344. So therefore, I'm going to change this, and I'm only going to include 344. So let's just talk about this quickly. They told us they correctly included 344, and that's why I can just plug in 344. Okay, I just plug in 344 because they said last year they recognized an assessed loss of only 344,000 Rand, which was done correctly. So we know this is correct. But let's understand the rationale for an assessed loss. I'm going to explain it now. I just want to quickly get this. Okay, so I just want to explain. So a deferred tax asset is an asset. An asset can only be recognized on the statement of financial position if it meets the recognition criteria. The recognition criteria says that future economic benefits can be measured reliably, and it is probable that you will receive that future economic benefits. So with a deferred tax asset, when a deferred tax asset arises, before you can recognize it on the statement of financial position, it needs to meet the recognition criteria. So number one, you can measure it reliably because you went through the tax calculation and you came up with 900,000 Rand assessed loss. So you are saying you have measured it reliably. But now comes the question, is that economic benefits that you expect in future probable? Is it probable that you will benefit from that 900,000 Rand in future? And the way we answer this question is the following. Management will have to make an assessment and decide and make a decision as to whether they believe that in future they will make enough taxable profit, they will make enough taxable income in order to offset that assessed loss. Why does this make sense? The benefit from the assessed loss is as follows. SARS is not going to transfer 900,000 Rand into your account. SARS says, if you have an assessed loss, what we will do for you is, in future, when you make taxable income, you first reduce your taxable income in future by whatever assessed loss you have. Okay, so take note of that. So therefore, from an accounting perspective, in order to recognize that asset, in order to say that this asset has future economic benefits that are probable, you need to ask yourself, will you have sufficient, will you have enough taxable profits in future in order to benefit from the 900,000 Rand? Because remember, if you don't have future taxable profits, you will never benefit from the 900,000 Rand because SARS is not going to pay it to you. SARS is only saying you can reduce future taxable income. So in order for you to benefit, you need to ask yourself, will I have future taxable income? So if you won't have future taxable income, then you cannot recognize the deferred tax asset. So if you will not have sufficient or enough future taxable income, then you cannot recognize a deferred tax asset. In that case, before you recognize zero, before you recognize nothing, you ask yourself, okay, I've concluded that I won't have sufficient taxable income in the future. Therefore, I cannot recognize this assessed loss as a deferred tax asset because it does not meet the recognition criteria. However, before you do that final part of saying you can recognize zero, you need to go have a look whether you have a deferred tax liability. And accounting says if you have a deferred tax liability, then you can reduce your deferred tax liability then you can recognize a deferred tax asset to the extent that you have a deferred tax liability. So take note of that. If you do not have sufficient taxable profits in the future, or let me put it this way, if you do not believe that you will have sufficient or enough taxable profits in the future, you cannot recognize a deferred tax asset. But before you recognize nothing, you go have a look, do you have any deferred tax liability? And if you do, the deferred tax asset can be recognized to an extent of the deferred tax liability. So by them saying the company have correctly recognized a deferred tax asset to the amount of 344, they are indirectly telling you that management believed in 2016. So management believed as at 31 December 2016 that there will not be sufficient taxable profits going in the future, and therefore we can't recognize an asset. However, the accounting standard allows us in that case to recognize a deferred tax asset to the extent that we have a deferred tax liability. So therefore we're recognizing 344, which is equal to the deferred tax liability of 96. So when we look at the deferred tax, the actual deferred tax, there will be no deferred tax because we'll have a deferred tax liability of 96, a deferred tax asset of 96, which gives you a net deferred tax of 0. So please take note of that. So therefore, what did we recognize as a deferred tax asset? 344, which came to 96,000 Rand, and we did not recognize the difference between the two of 556. So that's going to play a role in 2017. So I just want to get a total over here. So total deferred tax, it will be the sum and the sum. So we expect it to be 0. The reason being is we have an assessed loss, but the assessed loss can only be recognized to the extent of the liability. So therefore they net each other off to 0. Okay, over here, we also covered everything. So I'll do the same thing over here. Okay, and then I bring in the assessed loss. But now we have sufficient taxable income. Why? Because remember we made a profit of 5.7 million. We have a profit of 5.7 million. So that, and if we work, we will see now if we will have sufficient taxable income. But let's just quickly do this. So I'm going to do something quickly. Okay. So from a deferred tax point of view, so we go to movement in this calculation now. So our movement in temporary difference is going to equal to the 668. So the movement in temporary difference will equal to the 668. We're going to make this negative. So let's understand why are we making this negative. So let's understand why we're going to make this negative. So let's understand in future. So what we're having over here. So let's understand this deferred tax issue. Okay, so we're taking the temporary difference. We're not taking the 187. I want to tell you why. Why we're using the 668 and not the 187. I'll explain that now. But here it is positive. Yet when I'm taking it over here, I am making it negative. The question is why? So understand what we are trying to get to. We are trying to get to moving from accounting profit to taxable income, moving from an accounting profit to a tax profit. So we're trying to see what the tax profit would be from a SARS point of view. Now, let's understand this over here, this temporary difference. We have a temporary difference of 668. So we are saying, let's quickly get this. So we have a temporary difference of 668, which gives us a deferred tax of 187,000 Rand. Now I'm going to explain it from this point of view, but I'm talking about that over there. So let's understand. Using the same understanding of this taxable temporary difference. The question is, this is deferred tax, which is a future tax consequence. This is deferred tax, which is a future tax consequence. Also take note, deferred tax represents temporary differences, represents timing differences. So keep this in mind. Deferred tax is a future tax consequence, and deferred tax represents temporary differences due to timing differences. So the difference is temporary due to timing, okay? So we are saying in future, we have future economic benefits of 3.1 million, and in future, we're going to have a depreciation expense of 3.1 million going through accounting profit. So if we start off again with a 10 million Rand profit, in future accounting want to deduct 3.1 million. So they expect the accounting profit to be 10 million minus 3.1 million, which gives you 6.9 million. From SARS's point of view, they start off with 10 million. And in future, they're going to allow a deduction of 2.5 million Rand. So in future, they're going to say 10 million minus 2.5 million, which gives them a taxable income of 7.5 million Rand. Are you happy with that? So in future, we're going to pay them more tax than what we expect. So if we're going to pay them more tax in future, That means now we have to pay less. Because remember, deferred tax is a temporary difference. It ultimately means that over time, the tax that goes through in the income statement from an accounting and from a SARS point of view is exactly the same. The only difference that results is due to when the tax takes place. So if we're going to pay more tax in future, that means currently we have to pay less tax. And therefore, the 66.8 that we are paying more in future means now we have to reduce income tax. So that is basically the rationale. The other rationale as to why I'm using 668 as opposed to 187, because we are working out the taxable income line item, which is before the 28% line item. So remember, taxable income is the 100% and not the 28%. So please make sure you understand this direction. Please make sure you take the 100% line item and not the 28% line item. So that we'll do over there. Then we're going to get, sorry, let's undo this. Then we're going to have an assessed loss. So here we're going to say taxable income before assessed loss. If I'm you, I just set up this thing exactly the same. You go with accounting profit, list your permanent differences, have a line item with temporary difference, get taxable income before assessed loss, put in assessed loss. Even if there's no assessed loss, you just make it 0 just to get used to the way of calculating it. And then I'm going to get income tax after assessed loss. So now my income tax, my taxable income before assessed loss would be the sum of those. I started off with my accounting profit. I adjusted for 2 types of differences. Permanent differences, I list them individually because I have them nowhere else. Then I put in my temporary difference. Where did I get that? From my deferred tax calculation. Oh, sorry, I used the wrong number over here. I just need to fix that up quickly. I just need to fix this. I must use the movement in temporary difference. Movement in deferred tax. Movement in deferred tax, which is going to be 2017 minus that. Okay, so I'm going to bring in 324. Before I bring that in, actually, before I bring this in, I'm going to bring that in just now. I'm going to bring in my assessed loss of 900,000. Because I have enough taxable income, I can now reduce my taxable income by my assessed loss of 900,000 Rand. So therefore, if I add this up, my taxable income is 4.6. Remember, I'm still going to bring my temporary difference, but I want to first ask you for a few questions before I do the temporary difference. I want you just to look through this question over here. And before we deal with the temporary difference, I'm going to give you, it's now 20 past. We're probably going to run a bit over, just about 15 minutes over. So can you go from 20 from now, which is 25 past, up until half past to see what is happening? I'm going to give you 5 minutes to see what is happening. So I'll stop you by 28 minutes past, and then you can ask me if you have any questions. Okay, so I'm going to stop here, and then you can tell me if you have any questions. Because I'm going to go on another further tangent, which may be a little bit confusing. For those who want to type out any questions, if you have, just type out in the meantime. At least tell me you're going to have a question so I know if I need to wait before I move on. Okay, guys, any questions? Fakir, your name appears first as I'm just calling you out.
Maybe if you can just explain the sales loss thing one more time, just the sales loss.
Okay. So I want to explain it now. I'm going to explain it when I come to the deferred tax note. Okay. Rebecca, let's see who. Okay, so I got your question, Rebecca. Okay, taxable and temporary difference. Okay. Ashita, do you have any questions? I'm not sure if that one. Okay, Valise, nothing. Ashita, I'm not sure now if you said no questions now or earlier on. So, okay, no questions. Mahlati?
No questions from my side.
Ryan?
No questions.
So let's see, can't see all the names. Okay, Ashita, Fakir, Malati, Rebecca, Felice. Okay. Okay, so the taxable temporary difference. And so the question from Rebecca and Fakir, I'll answer now. Okay. So now we do the assessed loss. Because we are utilizing the fullest, so accounting never have an assessed loss. Okay, they don't have a balance sheet amount. From a SARS point of view, there's nothing as well because we are utilizing it. So therefore, that will be 0, 0, and 0. I'll explain the assess. I'll come back to the assessed loss afterwards. So therefore, the default tax, so movement in movement in through P&L would be the amount excluding the assessed loss, and then the movement in assessed loss would be, you follow the same formula, that minus that. So it's the only thing we take through is that of the movement in P&L. We don't take the assessed loss into account when we do the tax calculation. Okay. So I like to just do myself a check. You don't have to do this check. They don't care about the check. It's just the auditor in me that does checks for everything. Although I hate being an auditor, I still have some auditing, whatever you learned, whatever it's called. But anyway, auditors like to do checks for everything. I still have that in me to do checks. Okay, so I'm happy with that. So now we need to bring in the movement in temporary difference. Which movement do we bring in? The one relating to profit or loss. So this is the one excluding the assessed loss. So I'm going to say equal to, and I'm going to make it negative. It is going to be the 324. I'm bringing in the 324 because it's the 324 that represents the P&L. So remember, I had 668. What was the mistake that I did? I used the balance as at 31 December 2017. I don't want the balance. I want the movement from 2016 to 2017. That represents the 324. What's important, I brought the movement at 100%, not at 28%. That's the second important thing. So the first important thing is not to bring the balance of 668, but to bring the movement, which is the difference between 668, 31 December 2017, and whatever the balance was and the balance at 31 December 2016, which was 344. So important number one, bring in the movement. Important number two, bring in 100%, not 28%. Why? Because this number, taxable income, is 100% number. Okay. The second thing is, or the third thing is, why negative? Why did I change the sign? That answer was positive. I made it negative. If that answer was negative, I would have made it positive. Why am I changing the sign? If you were to explain this to the CEO, you can't tell the CEO that, oh, the calculation in the deferred tax was positive. So when I bring it into the workings for current tax, I make it negative. That means nothing to the CEO, okay? And it should also mean nothing to you. So why did I make this negative? Understand what is deferred tax. Deferred tax is future tax consequences. Deferred tax represents temporary difference between accounting and SARS. So there's a difference between SARS and accounting that is temporary. What does temporary mean? Meaning that the way accounting treats something and the way SARS treats something is the same, but when they treat it is different. So there's just a timing difference. So for example, accounting have an asset of R1,000,000. SARS also agrees that that asset is R1,000,000. But SARS says you must depreciate this asset over 5 years, where accounting says depreciate it over 10 years. So they're both depreciating R1,000,000. What goes through the income statement on both sides is R1,000,000. However, the R1,000,000 goes through SARS income statement over 5 years, but from an accounting perspective, it goes through the income statement over 10 years. So what do you know? Whatever the future tax consequence is going to be, the current tax consequence is the opposite, because it needs to net off to zero. So understanding that, this 668 represents a future tax consequence. Okay, I will answer that question just now. So, so this 68 is a temporary difference. The question is it a taxable temporary difference or is it a deductible temporary difference? The way you think about it is as follows. The way I'm going to explain it, well, you can use better wording, but the way I'm going to explain it now is how you write it to the CEO. But remember, you can choose better wording, okay? Because I don't know, my grammar is hundreds. Okay, so the 3168 tells us what we're going to depreciate in future. So from an accounting perspective, we want to depreciate, meaning we want to send through the income statement 3.1 million rand. So if we start off with a base point, let's say 10 million. I said let's say 10 million, so meaning for example. So for example, the profit on both sides, accounting and SARS, is 10 million rand. The only difference for this example, let's say, is plant and equipment. So in future, accounting and SARS both have profit of 10 million before taking into account the plant and equipment. Now we take the plant and equipment. So from an accounting perspective, in future, they expect to deduct 3.1 million. So when they work out their future profits, they say 10 million minus 3.1 million. So my future profits is 6.9 million, 6.9 million rand. Am I right? Yeah, 6.9 million rand. So we want to be taxed, or we expect, from an accounting perspective, we expect to be taxed on 6.9 million rand. Now we have to see what we're actually going to be taxed on. So from SARS's perspective, they start off with 10 million. They say in future, they're allowing for a deduction for plant and equipment, 2.5 million. So they say 10 million minus 2.5 million, give them a profit, a tax profit of 7.5 million rand. So they're going to tax us on 7.5 million rand. So in future, accounting expect to be taxed on 6.9 million, but we're actually going to be taxed on 7.5 million. Therefore, in future, we're actually going to have to pay more tax. That implies that this temporary difference is a taxable temporary difference because we're going to pay more tax in the future. And because it's a temporary, taxable temporary difference, we have a deferred tax liability. That's the explanation for temporary taxable deductible temporary difference. The question is, though, why are we putting through a negative? There it's positive, why negative? Because we're paying more tax in future, that means now, because we're working out the current tax now, that means now we have to pay less tax. And that is the reason why we are making it a negative, because in future we're paying more. So now it implies we have to pay less, in order to have that net difference of 0 over the full lifespan of the asset. So just keep that in mind. So that is the tax over here, taxable income. To get the actual tax, we're going to say 4.3 million minus 28%, because that's the tax rate. Remember, next year sometime it will be 27%. So now I can go take this answer and I can go and plug it in. And to make this green. So just take note, I deducted it because I'm calculating taxable income. Okay, so just remember why I deducted that, because I'm calculating taxable income. So now I can go over here. I go to current tax. And I'm going to say equal 1.2 million. Ashish, I'm going to answer your question just now. And then we're going to have 0 for prior year. I put it in red because it's not required. Because we don't have it in the question, so there's no need to write it down. Now we're going to deal with the deferred tax. Our temporary difference. So take note over here. In this calculation, we were working out taxable income to get to tax. And that is why over here, we brought in the 100%. However, over here, this is the income tax number, which is a 28% number. So that is why I bring in the 28% number over here. So if I go to the movements over here in this column over here, and I bring in the 28% line item. Over here again, I leave it positive. And the question is why? You need to think in the working, I'm calculating taxable income. I'm going from accounting profit to taxable income. So I'm dealing it from a SARS point of view. In this over here, I'm dealing it from an accounting point of view. So how does this differ? Because I concluded I have a taxable temporary difference. Because I concluded I have a deferred tax liability, my journal entry looks as follows. Because I concluded I have a deferred tax liability, my journal entry looks as follows. I have a liability is increasing. A liability increases on the credit side. So I say deferred tax, which is SFP. It is increasing. It is a liability. A liability increases on the credit side. For every credit, there must be a debit. What is the debit? It is the same number. But where does a debit go to? Income tax. A debit to income tax is increasing income tax, and therefore I make it positive. So you just need to play around with these and think through. I'm not going to go in much more detail. So when you practice, try to figure it out. If you don't figure it out, you can ask me in the WhatsApp group and so forth. If there's any questions relating to these, please don't message me directly. Message it in the group. The reason being is it's going to give everyone in the group an opportunity to actually learn. Then I'll respond in the group. So I explain what it is. You can rewatch this video to listen to my explanation and then attempt it. When you start to attempt it on your own, you'll be able to pick up whether you actually get it or not. To be honest, I only really got this, I think 2 years ago, when I actually did it in in the workplace. Then I only fully comprehend it. Before in the exam, I just could study it, read the notes with the understanding, but I didn't like fully comprehend it. I understood it, but I didn't really comprehend it. I only really comprehended like not 2 years, 4 years ago, 4 or 5 years ago, when I started working. Or no, I did work when I started actually being a financial accountant. Here we have 0 because it is nothing. And I'll tell you when you will get it once you start engaging with it. So you can listen to the video again, but attempt it by trying to work through questions. And then if you have any questions, send me and let me know. So just important, here's a few important stuff with this number. That number we are including in the taxable income calculation, and that is why that we have it as negative, given the explanation I gave you. So that's number 1. Number 2, I'm bringing it at 100%. Number 3, it's the movement. Over here, same thing. Number 1, it is the movement, but it is at 28%. Why? Because I'm busy with the income tax note. And then number 3, I'm bringing it as a positive because I'm not dealing with the taxable income calculation, which is a SARS calculation. I'm dealing with an accounting number, income tax. And if I look at the journals of what I processed, it means I need to I debited income tax. So therefore I need to increase, I need to have it as positive. So please make sure you can get this right. You don't want to be thinking about this in the exam. You want to do the thinking now. Just so you know how they sit an exam. When they sit an exam, they give it allocated time. How do they come up with an allocated time? They only give you time to do the question. They don't give you time to think about the question. Why? The thinking must happen before the exam, because the same principles are being tested. So you're supposed to have thought about it before your exam. The only time that they include thinking time is when it's something completely new. And you need to use the principles of accounting to come up with an answer. Then they provide some thinking time, but in most cases, time is allocated only to do. So that is why this thinking I'm talking about, and why positive, why negative, is it 100%, is it 28%? That type of stuff you need to do before the test, so that when the test happens, your brain is already automatically knowing what needs to take place. Okay. What did I just do? Okay, so the foreign income, it's easy. Plug this in. I never plugged it immediately, but you should plug it in immediately. 5,000 Rand. They told that it's 5,000 Rand. We just plug in 5,000 Rand. Don't wait till you come to foreign income, plug it in immediately. Now we come to the deferred tax asset. So here we have tax loss recognize. So look at the wording that gets used quickly. So look at the wording that gets used. So you must learn this wording. I just look from the psycho handbooks. I just look at the wording from the psycho handbooks, so I can never remember it. So we call it recognition of unused tax loss not previously recognized. I'll explain what this is. The wording I just get from the psycho handbook. And then we have an unused tax loss utilized. Unused tax loss utilized. So this one is easy. We're utilizing the full 900,000 Rand. Okay, so we're utilizing the full 900,000 Rand. So all I'm going to say is 900, 1, 2, 3. We're busy with the income tax note, which is a 28%. Everything's at 28%. So I multiplied by 28%. That is the unused tax loss utilized. Before I go into that, let me just do a workings for the assessed loss. I'm doing a T account for the assessed loss. Hopefully this will make us understand it. So just pay careful attention here now. We are running a bit over, apologize for that. So assessed loss, okay. So last year we recognized an assessed loss of 344, but at 28% it was at 96,320. Okay. So last year we had an assessed loss of 900,000, but we could only recognize 344, the temporary difference up to 344, which gave us an assessed loss of is it working now? Which gave us an assessed loss of 96,320. So in 2016, this would happen. So in the 2016 financial year, this is what happened. We have debit, credit. We had an assessed loss of 900,000 Rand. In order to recognize a deferred tax asset for an assessed loss, there needs to be future taxable. You need to, management need to be comfortable that in the future they will have enough or sufficient taxable income. They concluded that they did not have sufficient taxable income, so therefore they can't recognize a deferred tax asset. But but the accounting standard says in that case, limit your deferred tax asset to the amount of your deferred tax liability. So when we go look at 31 December 2016, our deferred tax liability was 96,320. Therefore, the assessed loss, the deferred tax asset, can be recognized to that limit. So now I can recognize an asset to the amount equal to our deferred tax liability. So recognizing an asset means we are increasing an asset. An asset increases on the debit side. So I say debit deferred tax asset. So I'm going to say debit deferred tax asset, SFP, and I can recognize an amount equal to the amount of the deferred tax liability, which is 96,320. For every credit, there must be a debit. Where does the debit go to? It goes to income tax. So here I have income tax, P&L. So it will go over there, 96,320. So therefore, going through my deferred tax balance, at 31 December 2016, I have a deferred tax asset of 96,320. So therefore, my opening balance in 2017 on 1 January 2017 is 96,320. So 96,320 opening balance. My closing balance of an asset is on the credit side. So the opening balance of an asset is on the debit side. My closing balance of an asset is on the credit side. So here I'll have closing balance. My closing balance is going to be 0. Why? I am utilizing the full 900,000 Rand. So therefore, there's no longer an assessed loss. Therefore, there's no longer a future economic benefit. So therefore, my deferred tax asset as at 31 December 2017 needs to be 0. But now let's just quickly total everything up over here. We need this account to balance. We need this account to balance. At this point in time, the account is not balancing. Okay, so it's not yet. It is not yet 0. So I need to make this account balance. So the way we do it is as follows. We can recognize the full assessed loss. We can recognize the full 900,000 Rand at 28%. Why can we? Because we have in the current year, we can recognize the full 900,000 Rand. Why? Because in the current year, we have sufficient taxable income to offset that full 900,000 Rand. That's what we picked up from working one, okay? However, we can't recognize the full 900,000 Rand this year because we already recognized 344,000 Rand of it last year. So this year, we can recognize the difference. So I'm going to say equal 900,000, 1, 2, 3, minus what we recognized last year, 344, 1, 2, 3, times 28%. So that is what I can recognize this year. Okay, so how did I get that? It is basically in 2016, we went 344. $344, 1, 2, 3. Remember, I have 900,000 in 2016, but I couldn't recognize anything because there's no sufficient future taxable income. So therefore, I can only recognize 0. But before I recognize 0, I need to have a look whether there is a deferred tax liability. There was a deferred tax liability that had a temporary difference of 344. So therefore, I can limit my deferred tax asset to a temporary difference of 344. But remember, we always take it 28%. I'm just talking at the 100% level now. So this year, because we can utilize the full 900,000 Rand, I can bring in the difference. So this year, because I can recognize the full 900,000, because this year I can utilize the full 900,000, I can recognize the difference between the 900,000 and what I recognized in previous years. There was only one previous year. So in the previous year, I recognized 344. So therefore, this year, I can recognize the difference between the full assessed loss and what I recognize. So here I'm going to say 900, 123 minus the 344. So that gives me the 556. If you add up the 556, I'm ultimately recognizing a deferred tax asset for the full 900,000 Rand. Last year, of the 900,000 Rand assessed loss, I recognized 344. Why? I could only limit it to what I had as a deferred tax liability. This year, because I have enough taxable income, I can recognize the full 900,000. But I said, okay, hang on. I can't just bring in the full 900,000 this year because a portion I brought on last year. So in order to get to 900,000, I bring on an additional 556. But remember, these amounts over here are at 100%. We're busy with a deferred tax asset account. Tax is at 28%. So this is what I'm going to say. Recognize. So technically, you're going to call it income tax, but this relates to so this recognized in 2016. This is recognized. So I'm going to fetch that. I'm not going to retype this whole thing out. This relates to that over there. Recognition of the so you are recognizing in the current year the portion you did not recognize in previous year. So here they're saying recognition of unused tax loss. So you're recognizing the portion that was not used relating to a previous assessed loss. Okay, so here that's what they call it, recognition of unused tax loss not previously recognized. Previously, you could have recognized 900. What did you recognize? Only 344. So this year, you are recognizing the portion you did not recognize previously. That's what we are doing over here. So here we can see, but remember, our account is still not balanced. Now we say, okay, we recognize 344 at 28% last year. We're recognizing what we did not recognize last year, which is the 900 minus the 344, which gives us 556 at 28%. So we're happy with that. But then we're saying, okay, but now we are actually utilizing it. So therefore, we need to write it off. So here we bring in what we are actually utilizing. So what are we utilizing? We're utilizing the full 900. We're utilizing the full 900. 900, 1, 2, 3, but remember at 28%. And that gives me my 252. I don't want to call that. I'm going to put it over here. This also goes to income tax. Okay, but what does this income tax relate to? Unused tax loss. What does that income tax relate to? It relates to the recognition of a previously recognized. So here I'm saying debit deferred tax. For every debit, there must be a credit. What is the credit? If I do it over here, if I do the journal entries, so in the 2017 financial year, if I do the journal entry, I'm saying debit deferred tax 155. For every debit, there must be a credit. The credit is going to income tax. Remember, a credit to income tax reduces income tax. Then I do again. Over here, it is a credit to deferred tax. So now I have a credit to deferred tax. So I'm saying credit deferred tax SFP. So I'm going to go fetch the number, credit deferred tax SFP 252. For every credit, there must be a debit. The debit to deferred tax always goes to income tax. This all relates to profit or loss line items. I'll take the full thing to profit or loss, and that's my journal entry. A debit to income tax increases income tax. That is why for the unused tax loss, it's positive, but over here, it's going to be negative 556,123 times 28%, because I need to reduce. So if I add up everything, it should come to 0. I mean, when I add up, sorry, no, I just said, when I add up everything, I should get to my income tax line item. Okay, so I'm just going to add up everything. You can see how they want to have subtotals and all of those kind of fancy things. You can include those subtotals, but that should be the income tax of 1.4 million. Now we can go to the tax rate recon. The tax rate recon, we need to subtract over here. We're going to say, we already said minus 74,500, but we're going to go at 28% times 28%. Okay, so we reduce. So the tax rate recon would have that 20, let's do this. The 20,000 Rand. Sorry, the one that. This is 0. I just brought it in for our purposes, so you're not going to include it, really. I just brought it in for a completeness point of view. Now let's work out the foreign income. The foreign income we know was 5,000 Rand. Okay, the tax on foreign income was 5,000 Rand. That is what we know. We need to see what we should have been if SARS had to tax us. SARS should have said 40,123 times 28%. From an accounting perspective, they expected to be taxed at 11,200, but they actually got taxed at 5,000. So therefore, the permanent difference is the difference between these two. Okay, so the permanent difference is the difference between those two amounts. The next one is on the tax on the capital gains. Where was that now? Where is that now? Okay, I don't know where that is. But anyway, the capital gains, which was 300 and, I'm just going to go fetch it quickly. So it's equal to the workings. There's the 70,000, but what we're going to do, we can't have that 70,000. It's going to be 70,000 times 28%. So then it is the 19,600. So when we add up everything, we should get to something. So I have one last thing. We're also going to bring in, so what also comes in a deferred tax question is your that deferred tax. I'm going to provide you an explanation over here. We take the number exactly as is. So when I add up everything, we should end up with the 1.4 million. So just to do a check for yourself, we're going to say that minus that, it should be 0. The fact that it's 0, we are happy. So let's understand, why are we bringing that line item in? So this is something you need to wrap your head around with the tax rate recon. The tax rate recon deals with permanent differences between accounting profit and taxable income. So the tax rate recon represents permanent differences between accounting profit and taxable income. Okay, very important. The accounting profit over here is accounting profit before tax. Okay, so please take note that the tax rate recon deals with deals with the reconciliation between accounting profit before tax and um, income tax. Okay, so take note of that. And sorry, I actually worded it incorrectly. The tax rate recon deals with a reconciliation between tax at 28% based on accounting profit before tax and the actual income tax line item. So how we gonna, what goes through the tax rate recon are all permanent differences between this, between the two green highlighted numbers. So any permanent difference between the two green highlighted numbers will filter through the tax rate recon. And this is how you think about it. If something is included in this tax the tax of 1.6 million, the accounting tax number, and will never be included in the income tax line item, which is a SARS number, then you need to include it in the tax rate recon. Similarly, if something is included in the income tax line item and is never included in the accounting tax number, then it will also be included in the tax rate recon. So to put this to test, included in this 1.4 million rand is this 155,000 rand. So included in the 1.4 million is this 155. However, in this 1.6 million, that 155 will never ever be included. Why? This 1.6 million is 28% of profit before tax. What is profit before tax? Revenue and income and expenses. So what is profit before tax? Income and expenses before tax. If you look at this journal entry, this journal entry is purely based on income tax and deferred tax. It does not hit a line item that impacts profit before tax. Because this journal entry is going directly to income tax, it is not going through income and expenses, it's going directly through into income tax. It is not hitting the profit before tax line item. So therefore, when you say profit before tax multiplied by 28%, you are never ever going to capture this 155,000, because that 155,000 goes directly into profit, goes directly into the income tax line item. So as a result, the income tax line item would have this unused tax loss, whereas profit before tax would never have that unused tax loss. So that causes a permanent difference, and hence you will have to have it as a reconciling item. So I'm going to stop there for tonight. There was a lot of information. If you have any questions, you can let me know, but you first need to practice and go through this before you ask me any questions. And as you go through it, then ask me, because then we will be in a better position to actually explain further. But that's all from my side. Before we call it an end, do you guys have any questions for me? I'm going to do the same as last time. You can ask me a question. If you do have a question, I'll answer it. But after you ask your question, or if you don't have a question, two things you need to answer for me. Number one, what did you actually take out of this lesson? What did you learn? And number two, what is still confusing? Okay. So we can start. Sorry, Fakir, your name always pops up first.
Yeah. So what I took out of this lesson was Uh, Basically, the assessed loss was an issue for me because I attempted a previous question where there was assessed loss and I didn't exactly go to this detail of it. So yeah, the assessed loss, that's what I picked up, and basically just the smaller things of how to handle it when you take an item at 100% and 28% and those things. So that is what I've learned from there. What's still challenging for me? I think I just need to practice this question a few more times to make it 100%.
Yeah.
There's a couple of things that I still need to check out, but yeah, that's all from my side. No questions.
Okay. Mahalati?
I think what I've learned, and I think it's going to be helpful because it's something that I am aware that I've been struggling with since undergrad, is the deferred tax calculation. And now I'm realizing the reason I was struggling is because I did not understand certain terminologies. Like, for example, the fact that there is deductible taxable differences, temporary differences, I mean, and taxable temporary differences. So I did not understand the theory properly. That's why I was struggling. And I think what I'm still not grasping my head around is the calculation you were doing just now. Like, I think it's basically the main thing is to understand what the question is actually saying and the information they're giving you, and understanding what you need to do with that information. So I think that's what I need to work around.
Okay. Ashita, do you have anything? Oh, it is. There's a message here. Okay. Any other confusing points? Felice, so Ashita's probably still typing. Felice, do you have anything you want to say or type?
What really stood out for me here was also the assessed loss calculation. I think that's also something I have not yet really wrapped my head around. I also have to question it. Practice it a lot more to fully understand it and see. Just by listening tonight was very helpful for me. Even in the prior Zoom meeting, we also did, not in the prior one, but the one you did previously of the income tax calculations.
Yeah.
It also helped me a lot. Everything I see now, how you do everything and how the calculations just actually fall into place. It's much more clearer to me.
Okay, that's good.
And a challenge is still the assessed loss that I think I will still have to practice.
Okay, we'll try to just pull out assess loss part, and then I'm going to ask you guys to maybe attempt just the assess loss and how it'll filter into the various parts, and then we'll see how it's from there. Ashita, have any confusing points at this point? Yes, no, yeah, okay, let me just see. Okay, so the assessed loss for the 2017. The reason why, I'm not sure which part you're talking about, if you're talking about from the deferred tax calculation or the note. So from the deferred tax calculation, because I know that was your previous question, there's nothing for the deferred tax calculation for assessed loss because you are fully utilizing it. So therefore, going forward, because remember, deferred tax is a future tax consequence. So going forward, there's nothing because you're using everything now. So that is why in the deferred tax calculation, it is 0. In the other part, it is, that will be a separate, but I'm going to pull out some more questions that we will focus just on. I'll maybe give it to you this weekend. Then you guys can work through it, and then you can maybe let me know, and we can work through some more via WhatsApp or so. But otherwise, guys, thank you for today. I still need to manage my time when it comes to a hectic question of this nature, because we want to try to keep it within 90 to 1.5 hours to 2 hours, so that it's actually much more fruitful and beneficial, as opposed to going almost for 3 hours, because then we basically all just lose concentration and the actual lesson becomes less impactful. So I need to work on that. I guess what I'm going to do is a hectic question. I'm going to skip the 30 minutes of recap, and we go straight into the question. And as we do the question, we will recap, just to avoid this, so we can have a proper 90 to 2 hour session and not actually reduce the impact by having it so long. Okay. And also, you guys block out your calendars for a certain time. You may have other commitments and so forth. So just to, I'll make sure going forward it's a bit better. But just remember, next week we're gonna have we're gonna have double classes. Okay. In preparation for test one. I'll send out some meeting requests later tonight. Okay, cool, guys.